Inflation can be a significant concern for individuals, companies, investors, and politicians alike. In this video, we delve into a hierarchy of investment categories and how they perform during periods of inflation. Drawing from the wisdom of legendary investor Warren Buffett, who has witnessed his fair share of inflation, we explore the best and worst investment options in an inflationary environment. Discover how you can protect your wealth and even thrive during times of rising prices. Are you seeing signs of inflation beginning to increase? We're seeing very substantial inflation, and it's quite interesting. Prices are on the rise, and what's even more intriguing is that these price hikes seem to be widely accepted. Inflation has become a top concern for everyone, including individuals, companies, investors, and politicians. Over the last year to 18 months, the topic of inflation has dominated conversations. In this video, we're going to take a deep dive into a hierarchy of different investment categories and how they rank in periods of inflation. And all of this insight is straight from the playbook of the renowned investor Warren Buffett, who at 91 years old certainly knows a thing or two about inflation. Now, before we get started, I have a small request. Please hit that like button. It really helps the channel. And if you haven't already, consider subscribing to the Elite Economizer. Okay, now let's get into the video. At the bottom of our inflation hierarchy, we find cash. Cash during a period of inflation is like watching your money evaporate. Warren Buffett isn't the only one who dislikes holding cash during inflation. Fellow billionaire Ray Dalio has also famously stated that cash is trash. This is because during times of inflation, the cash you have sitting in a savings account or under your mattress loses value day by day, week by week, month by month, and year by year. One of the most important takeaways from this video is the concept of real return. It's a simple but crucial concept in investing. Let's say your investments earned you a 10% return in a year. That sounds great, doesn't it? But here's the catch. It depends on what the inflation rate is. To calculate your real return, you need to subtract the impact of inflation. So if inflation is at 7% and your investments return 10%, your real return is only 3%. Not as exciting as you initially thought, right? That's why cash is at the bottom of our hierarchy, because holding on to cash during inflation essentially means you're losing money. Moving up the hierarchy, we find fixed interest rate bonds. These investments are typically considered safe, but Warren Buffett argues that they're not as safe as they seem when you factor in the impact of inflation. Let me explain. Currently, the yield on a 10-year U.S. government bond is around 1.8%. If you were to buy one of these bonds today, you'd lock in a 1.8% annual return for the next decade. But what if inflation averages 4% over that period, which is not unreasonable given recent inflation rates? In this scenario, your real return after factoring in inflation would be a meager 2.2%. It's better than holding cash, but it's still far from an ideal investment. Now let's talk about something that's a bit more promising. If you're borrowing money in a long-term structure at a fixed rate, you're in a good position during inflation. For example, if you used a 30-year fixed-rate mortgage to buy a house when interest rates were low, your mortgage payment remains the same over the next 30 years. As inflation eats away at the value of your mortgage debt, you'll effectively be repaying it with devalued dollars. Next up in our hierarchy are unproductive assets, such as gold, silver, and other precious metals. These assets can act as a hedge against inflation, as their value tends to keep pace with rising prices. However, they might not significantly increase your purchasing power. Warren Buffett once compared all the gold in the world to a cube that's roughly 67 feet on each side. The value of all that gold would be around $7 trillion at today's market prices. In contrast, you could buy all the farmland in the United States and several major corporations and still have $1 trillion in walking around money for the same price as that cube of gold. So while unproductive assets like gold have their place, they might not be the best way to grow your wealth during inflation. Now let's discuss productive assets, particularly what Buffett refers to as productive assets, great businesses. These are the kinds of businesses that can not only keep up with inflation, but also outperform it. Buffett made his fortune by investing in such businesses. The key here is to find companies that require minimal capital reinvestment to maintain operations. Businesses like Apple, Coca-Cola, and See's Candies fall into this category. They have strong brands and don't need to pour all their profits back into the business to sustain it. Pricing power is another essential characteristic of a business that performs well during inflation. Consider a company like Apple, where customers are willing to pay a premium for its products. Even during times of rising prices, Apple can increase its prices without losing customers. On the other hand, businesses without pricing power struggle to raise prices, even in normal circumstances. These are often companies in commoditized industries where consumers primarily care about finding the lowest price. Now let's dive deeper into understanding the impact of inflation on different investment categories, as outlined by the wisdom of Warren Buffett. Productive assets. Great businesses. Moving up the hierarchy, we arrive at what Warren Buffett often refers to as productive assets, or simply, great businesses. These are the crown jewels of investing during inflation. Consider the scenario of an individual named John who decides to invest his $1 million in developing a software product. This software simplifies video creation for YouTubers, making their lives easier. In John's first year, he earned $1.2 million from this software, resulting in a $200,000 profit. Now here's where it gets interesting. If there's 20% inflation, the price John charges for his software can also increase by 20% from the previous year. This means that the $1.2 million he earned last year turns into $1.44 million in the current year due to the inflationary effect. But what sets this business apart is that John doesn't have to reinvest a significant portion of his profits back into the business just to keep it running. This is what we call a capital-light business. The minimal reinvestment required means John can enjoy the profits instead of constantly funneling them back into the business. Now, consider this scenario in contrast to the previous example of a capital-intensive business like the equipment rental company. John's software business doesn't require substantial capital to maintain. In the case of inflation, this means he can take his profits out of the business without worrying about a significant portion of it being eaten up by operational costs. This distinction is vital. While some businesses require massive capital reinvestment, others can operate efficiently with much lower capital requirements. And during inflation, those businesses with lower capital demands tend to perform remarkably well. So what kind of businesses generally have these low capital requirements? Typically, they are companies with strong brands and those that don't rely heavily on owning vast physical assets like factories or inventory. Think of iconic brands like Apple or Coca-Cola. Companies like these don't need to constantly pour money into their businesses just to maintain operations. Furthermore, many technology-focused companies fall into this category. Once the software is created and the initial expenses are incurred, ongoing costs are minimal compared to most traditional businesses. So if you're looking for investments that shine during inflation, keep an eye on capital-light businesses with strong pricing power. Pricing power. The ultimate shield against inflation. Pricing power is an essential concept when evaluating a company's ability to thrive during inflation. It's more art than science, but understanding it can make a significant difference in your investment choices. Here's a straightforward exercise to help you gauge pricing power. Imagine a company that raises its prices by 10%. How would its customers react? If customers willingly accept the price increase or even welcome it, that's a strong indicator of pricing power. Conversely, if customers balk at the price hike and consider alternatives, it's a sign that the company lacks pricing power. Let's revisit Apple for a moment. Apple has such a loyal customer base that many Apple enthusiasts are willing to pay a premium for their products. Apple's pricing power is so strong that customers rarely switch to competitors solely because of price. They're willing to pay whatever Apple asks. This is a clear demonstration of pricing power. On the other hand, consider a company that sells generic, unbranded white t-shirts. These t-shirts are virtually identical to those offered by competitors. Customers shopping for these plain white shirts are primarily price sensitive. If one brand raises its prices significantly, customers are quick to choose a cheaper alternative. In this case, the company lacks pricing power. Now, why is pricing power so crucial during inflation? Inflation leads to rising costs, including the expenses for materials, labor, and shipping. Companies with pricing power can pass these increased costs on to customers without losing business. Their ability to raise prices allows them to protect their profit margins and, in many cases, increase them. Conversely, companies without pricing power may find themselves trapped between rising costs and the inability to charge higher prices. This situation can erode profit margins and, in extreme cases, lead to financial difficulties. Warren Buffett's wisdom on inflation emphasizes that investing in companies with low capital requirements and strong pricing power is the key to thriving in an inflationary environment. While inflation may be a concern for individuals, companies, and investors alike, making informed choices about where to invest your money can help you navigate these challenging economic conditions. Investing in yourself, the ultimate inflation hedge. Warren Buffett shares a valuable piece of advice that stands out above all others when it comes to combating inflation. The best investment you can make is in yourself. Buffett explains that if you're highly skilled or the best in your field, your earning power remains intact. You don't have to keep re-educating yourself constantly to maintain your value. Imagine being the leading brain surgeon, lawyer, dentist, plumber, or accountant in your town. People will eagerly seek your services, and you can charge a premium for your expertise. Your earning power remains strong, even in times of inflation. Investing in yourself through education, skill development, or becoming the best in your profession ensures that you're always in demand, regardless of economic conditions. So while we've explored various investment categories and strategies to protect against inflation, never forget that the ultimate inflation hedge is the investment you make in your own skills and knowledge. In conclusion, understanding how inflation impacts different investment categories and following the principles outlined by Warren Buffett can help you make informed investment decisions. Cash may be the least favorable option during inflation, while productive assets, great businesses, and investments in yourself can serve as powerful shields against the eroding effects of rising prices. Whether you're an individual or an investor, navigating the challenges of inflation requires a thoughtful approach and the wisdom to choose investments that stand the test of time. As we wrap up this discussion on inflation and investments, I hope you've gained valuable insights into how to protect and grow your wealth in an ever-changing economic landscape. Remember, informed investing is a journey, and the more you learn and adapt, the better positioned you'll be to achieve your financial goals. Thank you for joining us in this exploration of inflation and investments. As always, if you found this video informative, please give it a thumbs up and consider subscribing to the Elite Economizer. Our goal is to provide you with valuable insights to help you become a better investor. Talk to you soon.